Hey guys, welcome to Individual Investor. A couple of weeks ago, I read for the second time this book, The Little Book That Still Beats the Market by Joel Greenblatt. If you haven't read this book, I highly recommend it. It is a lot of fun and definitely one of the easiest books to read on stock investing, especially if you're new to investing. So, yeah, check it out. Now, more importantly, is that this book preaches something called the magic formula, which is this formula created by the author, Joel Greenblatt, that if you follow, then you're supposed to get better results on the market. So this video is actually the first one of a series of videos that I will be doing on this magic formula investing as described in the book. And I'm going to be documenting and sharing with you the results. So as you can see, this book is pretty short, and if you read it already, well, it takes about 2 to 3 hours or even less if you're a fast reader. So I'm not going to be spending too much time talking about the book. What I want to highlight here is the core message or the fundamentals of the magic formula. So the magic formula consists of using screening criteria to find good businesses at bargain prices, which should sound very familiar to value investors, right? That's what value investing is about pretty much, right? It's about finding companies, finding solid businesses at bargain prices, right? So how do you find good businesses or solid companies? Well, the way that the magic formula screens for this criteria is by looking at the return on capital. So companies with high return on capital are considered good businesses because they can take the income or the earnings that they generate and reinvest those back into the business in order to generate more returns or better returns over the long term to the stockholders. And the second element of the formula, finding companies at bargain prices, is achieved using the PE or price to earnings ratios. So the formula will screen for stocks trading at low PE ratios or high earnings yields in order to find these bargain prices. Now, the way that Joel Greenblatt defines return on capital and earnings yield is slightly different than what you find in other investing books or on websites like Investopedia. So let's recap how the author defines return on capital. If you have the book handy, you can go to page 138, but I have a screenshot here. So return on capital is defined as the EBIT divided by the net working capital plus the net fixed assets. All right. And earnings yield, which typically is just the inverse of the PE ratio. In this case, the magic formula uses or defines earnings yield as EBIT divided by enterprise value. So if you follow this magic formula and you screen or rank stocks based on high return on capital and low PE or high earnings yield, then you have a pool of stocks that allows you to build a portfolio that, according to the author, beats the market. So basically, if you follow this formula and you build a portfolio using stocks selected by the formula or by this system, then you have guaranteed results that will beat the market over the long term. The one caveat or warning that they highlight in the book is that this formula beats the market over the long term. This means that you have to stick to the formula for at least 3 years. If you start using the formula according to the author, and after 1 year or 2 years you see that you're getting worse results than the market and you quit, then you're not giving the formula enough time to work its magic. So you have to stick to the formula for at least 3 years. And in the book, they demonstrate these results by testing this strategy using 17 years worth of data. And in those 17 years, the formula did beat the market or the S&P 500. But if you were to grab single years or periods of 1 to 2 years from that 17-year window, then you will encounter some segments where the formula didn't beat the market. But if you look at the overall 17 years or at a long-term horizon, then the formula does beat the market. So again, I'm starting this month in January. In fact, I have already started a couple days ago investing using the magic formula, and part of my plan, which I will share with you shortly, is that I will stick to the formula for at least 3 years, whatever happens. If I'm losing money, if I'm getting terrible results, I'm gonna stick to the formula for 3 years to see if it really works. All right, let me explain the rules of the game, or exactly how I will be investing using the magic formula, which is pretty much 95% of what the book recommends. I'm following the instructions to the letter, except for one minor tweak that I will explain in just a second here. So to start off, I will invest $20,000 per year over 3 years for a total of $60,000. I am going to be using the official screening tool, from the book, which is which you can find on magicformulainvesting.com, which is this one right here. So you have to create an account. It's free of charge, and basically super simple. You specify your market cap and the number of stocks that you want to screen. Then you get your stocks, and then in this case I'm getting 30 stocks, and these 30 stocks all have high return on capital and are trading at low PE ratios or high earnings yields. All right, and here the fourth bullet point is actually the minor tweak that I'm going to be implementing to the formula. So basically I'm going to remove all consumer cyclical, discretionary, and retail stocks. So basically I'm not going to be buying any stocks from those sectors. And the reason for that is very simple, is the pandemic, COVID, right? I want to make sure that this strategy works over the long term, and with all the uncertainty in the market around new variants of COVID, or further lockdowns, etc., then these sectors in particular get impacted more heavily. So I'm gonna be just ignoring them, and this is totally okay, because again, if you read the book, basically the goal is not that you have to follow or buy every single stock from the screener or from the magic formula. They also recommend that you can use the screener as an initial filter to find some stocks, and then you can cherry pick the stocks from the initial screen. Something to note is that they do recommend that you select at least 20 to 30 stocks. Okay, so you can cherry pick your stocks from the list, but make sure that you are diversifying and that you are at least picking between 20 to 30 stocks. All right, so next I'm gonna buy the top 5 stocks in equal weight every 3 months, with the goal of building a portfolio of 20 stocks. Why 20? Because I'm investing $20,000 and I want to keep things simple in equal weights and even. So I'm going to be investing basically $1,000 in each stock, and that's why I selected 20 as the number. Nothing in particular there. And then lastly, after a year of holding each stock, I will sell them or increase my position in those stocks by another $1,000 if they appear again as the top or in the top 5 of the magic formula screener. All right, so that's basically those are the rules of the game, and that's what I'm going to be following over the next 3 years. All right. Here I also have the timeline or the schedule to actually make sure that I'm following my own plan very thoroughly. So right now we are in January, so the goal is to run the formula and pick the top 5 stocks. All right, and then I'm going to invest 5K in stocks 1 through 5. Okay, then 3 months later, in April this year, I'm going to run the formula again and pick the top 5, but excluding previously selected stocks if they show up again. So basically, if I run the screener again 3 months, or in April, 3 months from now in April, and some of the stocks that I already bought show up in the top 5, then I will ignore those and then pick the next ones in the list. Okay. In 2023 and 2024, as you can see, the plan is pretty much the same, right? With the slight difference that if the stocks show up again, I don't know if this is even possible or if this will happen, but let's say that a stock that I buy today shows up in the screener or in the magic formula 1 year from now, then I think that I will maintain the position, but I'm not entirely sure. I might increase the position, because if the stock is showing still high return on capital and still trading at low P ratios, then maybe the market hasn't realized the true value of the stock. I don't know. I think I'll play it by ear. The book doesn't really tell you if you should maintain your position. The book basically says that after a year, you sell all your stocks and then you run the formula again. But yeah, we'll play by ear. Maybe they won't even show up, but yeah, we'll see how that goes. And then obviously I'm gonna be selling all the other stocks, right, that do not appear again in the screener. All right, and then rinse and repeat. And yeah, after 3 years in 2024, actually probably in January 2025, I will be reporting to you guys the overall results of the 3-year period using the magic formula. Something else I want to show you guys is actually how I am tracking this. So actually today, Sunday, I went ahead and on Wednesday this week, I ran the magic formula and already picked some stocks and bought positions into those stocks. So here I have the screenshot of the magic formula from Wednesday, and here I have the top 9 stocks from the magic formula. And as you can see here, I have I highlighted in yellow the ones that I rejected, basically the ones that I'm not going to be buying because of the criteria that I previously explained. So the first one is a consumer cyclical stock, and then the fourth one, BRLT, another cyclical, BKE, another cyclical, and then this one, CIAFF, is actually a basic materials stock, but it's not available at my broker. I'm in the UK, I'm using Interactive Brokers, and they don't have this stock available, so I had to pass on that. So I grabbed the next one. Okay, so these are the 5 stocks that I bought positions into. Okay, and here in the next tab I have the transactions. So here we have them 1 through 5. I'm gonna be filling these out over the course of the year. Let me go now to my Interactive Brokers account. Here I have my positions for the magic formula. Okay, those 5 stocks that we saw previously. And if we look at the performance, yeah, I am down as of January 7th, 1.17%. Not too bad, but again, we'll see what happens, right? We have to wait at least 3 years to see if this magic formula works. This is the very first video of a 3-year journey using the magic formula with real money. I know a lot of you out there, and I've seen a lot of other investors that they are completely against following any system, formula, or tool that tells you when to buy and when to sell stocks. And to be honest, I agree. Right? You should do your own analysis. You should come up with your own conclusions about stocks that you wanna purchase, and the reason behind the purchase, right? Following blindly a system like this, it doesn't feel very good. However, the way I view it is that the reasoning behind the formula is pretty valid, right? And I don't see my capital, or I don't see that the risk is loss of capital in this case. I see that the risk will be that, well, I might underperform the market for a couple of years, and my money would have been better off being placed in an index fund, or something else. So that's the risk that I see. I don't see this. Obviously, these are companies that have at least high return on capital, and the portfolio is diversified to some extent, right? I'm going to be buying 20 stocks, so I don't feel that my entire capital is at risk here. I just see the risk as, underperforming the market, which will suck if that happens, but it's not the end of the world. But at least, we would have tested the magic formula according to the book, and yeah, I think that the results will be worthwhile whatever happens. So, yep, that's all I have. Thank you guys so much for joining me today, and yeah, I'll look forward to seeing you in my next videos. Take care.